Well, hello everyone, it's Ben Hardy here, and in today's video we have to talk about where people are actually getting their cash to buy cars with, because once you find out, you are going to be absolutely appalled. Before we get into this video though, as always, if you want to save time and money the next time you purchase a car, link to my car buying guide in the description down below. And then if you want to see more videos just like this, then I recommend you subscribe because I post content every single day. Let's get into it. So we actually have to talk about two different markets, the car market and the house market. Now, I am not an expert in the housing market. I just have to put that disclaimer there, but I know quite a bit about the car market, and you'll understand when we're talking about the housing market in a second. So anyways, with car prices over the last few years, they've increased by a pretty substantial margin. Used cars at the peak had increased in value by like 50%. Now, over the course of 2022, some of that value had kind of eroded away. On the retail side of things declined by about 9-ish%. On the wholesale side of things, closer to 20, well, actually over 20%. Now, with the housing market, we are currently seeing, price declines right now. But throughout 2021, housing prices increased on average by over 18%. In 2022, it was over 12%, which is way more than historical norms. Apparently, historical norm is in the 4 to 6% range with what you expect with housing increases. And so what this did to both markets is create a lot of interesting effects. So when it came to the car market, well, the price increases actually weren't all that bad to the consumer because interest rates were so low. And so although the prices were just astronomically high at the peak, people were able to borrow money for so cheap that they were fine with paying those prices because the monthly payment worked with their budget. And then the same thing happened with houses as well, because house prices kept running up and people were able to borrow money for cheap, and so they kept paying. But the important thing to talk about is not about the people that purchased houses or cars during the pandemic. It's to talk about people that purchased houses or cars prior to the pandemic, because these groups of people were in a situation where they purchased these items and they are now worth far more today than they were worth prior to the pandemic. Even after the declines, if you purchased a used car or a new car prior to the pandemic, then most likely you're in an equitable situation. And then if you purchased a house prior to the pandemic, then you are also most likely in an equitable position, again, despite the declines that we have seen. So with all of this equity around in the market, it obviously led to a lot of people going and spending that equity, because that's the American way. Obviously, a smart financial, I guess it's not smart, but rather a financially conservative person would take that equity and just hold on to it and try to increase that equity over time, right? If you have equity in your house, then continue to increase that equity by continuing to pay down your house. And same thing with a car, right? If you have equity in your car, then continue to pay it down until you have even more, and then eventually, pay off the car. But that's just not what, most people do. What most consumers do the second that they have any amount of equity in any sort of thing is they go and sell it for something bigger, newer, and nicer. It happens with cars and it happens with houses. And so this has led to some pretty interesting financial decisions on behalf of a lot of people over the last few years. And this is still happening today. Like, this is not something that happened last year that has stopped. Like, people are still doing this today. I talked to a bunch of dealers about this over the course of this last week, and I'm shocked by how many people are doing this. So this all comes down to the home equity side of things, because although vehicle equity was good for a lot of people, most of that got erased because these people that had a lot of equity traded in their vehicles at the same time that vehicle prices were at an all-time high. And so it just kind of like zeroed out the whole situation. And if they waited until vehicle prices started to come down like what we see today, well, then a lot of that vehicle equity, there's probably some still there, but it's eroded. But with home equity, there's still quite a bit for a lot of people, again, especially if they purchased prior to the pandemic. And so what a lot of these people have been doing with home equity is they've been taking out home equity loans. So again, I'm not an expert in this field, but to my knowledge, and correct me if I'm wrong, what a home equity loan typically looks like is a lender will basically look at your house and see how much your house is worth, and then look at your mortgage and see how much that is currently valued at, right? How much do you owe left on your house? And if you're in a position where your home is worth more than what you owe, then you can actually borrow against your home. And what this will typically look like is a refinance on your home. So let's say that your house is worth, $400,000 and you have a loan for $200,000. Well, what you could hypothetically do is basically take out a loan for $200,000 more against your house, refinance your whole mortgage. So now you're paying, a $400,000 loan, and then you get $200,000 in cash money, right? And and again, I do believe that there are some tax implications to this, but again, someone who's way better in this whole situation, please comment down below so you can answer. But all that you really need to know for today's video's sake is people did a lot of refinancing over the last few years because of lower interest rates, and they didn't just, refinance their loan to make it so they had a lower payment. They did what every American likes to do, is they refinanced their loan with a home equity loan to where they could pull cash out of their house, right? They want some of that sweet, sweet equity. And this big bundle of home equity answers a question that I have been trying to answer for the last year. And that question is, where the heck have all of these cash buyers been coming from? So if you've been following these videos, then I've talked about how there are more cash buyers today than there has been historically. When I worked at the dealership, I pretty much never encountered cash buyers. I shouldn't say never, but it was very rare that someone would actually pay cash for a car. If someone came in and said they're going to pay cash for a car, 9 times out of 10, they were actually just working with a bank or credit union to get a loan through them, and then they were bringing that check in to pay for the car, but they themselves weren't actually paying cash for it. There was a very small percentage of people that truly paid cash. But right now, in today's market, there are a lot of dealers that have a cash pay rate of 50% or higher. And this is an actual cash pay rate. These people aren't going and getting loans from lenders and then giving, a check to the dealership based on that loan that they got. No, these people are actually pulling money out of their own bank account and paying for the car in full. Which, again, on the surface, it hasn't made any sort of logical sense, because the average brand new vehicle is around $50,000. And if you look at the average savings rate in the US, where it's only I think $4,000 or $5,000, 2 plus 2 equals 4, right? It doesn't make sense that you have a 50% cash buy rate on vehicles with a lot of different dealers when the average consumer doesn't have $50,000 sitting in their bank account. And so I thought, okay, well, maybe this is just a small subset of people that saved a bunch of money over the pandemic, and maybe they just weren't reported on these reports. And that could be some of them. But that's still it just didn't add up. And so what I started to hear from dealers is that they've had a lot of customers tell them where they get the cash from. And where they're getting the cash from is those home equity loans that I talked about earlier. So people are literally borrowing against their house, taking out a bigger mortgage, right? Refinancing their house. And this is something that was probably done about a year ago when interest rates were significantly lower than today. People aren't really taking out home equity loans as much today because interest rates have increased. But about a year ago, right, they got that money, and a lot of people have sat on it for a while, and now they're using this money to buy cars. And so, again, I'm not a financial advisor, not financial advice, any of that kind of stuff, but it just seems like a poor decision in my personal opinion, because historically, houses generally, tend, here in the US at least, tend to slowly go up in value. Yes, there are a lot of expenses associated with owning a house. I know that because I personally own a house, and it's so annoying, all the things you have to put money into. But still, it's something that will eventually be worth more money than, what you paid for it, again, typically. But a car, on the other hand, it doesn't do that, right? Cars tend to depreciate, especially new cars, and this is where a lot of these cash purchases are happening, is with brand new vehicles. So in summary, we saw a massive run up in car prices and house prices over the last couple of years, and this put a lot of people in a position where they had quite a bit of equity in both of those items. And just like what any person here in the US does when they have equity in an item, is they go and purchase another nicer, newer, shinier item. And again, I don't have a problem with that. I don't have a problem with consumerism. I know that some people seem to be really negative about it, but our economy wouldn't be as big as it is if we didn't have a consumer-based economy. With that being said, though, not financial advice, but I think it's a little bit misguided to take out a loan against your house to buy a car. You have to remember, again, generally speaking, houses appreciate in value, cars depreciate in value. Why would you be taking out a bigger loan against something that is appreciating to pay cash for something that is going to depreciate? And I understand that people are going to say cash is king with cars, and that would make sense, right? You don't want to loan on something that's depreciating, but at the same time, the loan types that you see on cars versus houses are so different. With most mortgages, people are going to take out a 20, 30, 40, maybe even 50-year loan. I've seen some pretty long loans with houses, which is crazy to me. I just don't understand it sometimes how long these loans are. But anyways, The loan term is so much longer on houses than it is on cars. And so like, let's say that you're going to buy, I don't know, let's just say you're going to buy a big fancy $100,000 car, and so you're going to take out a $100,000 home equity loan. Well, you have to remember, if you'd instead just taken out a regular car loan on that, then you'd be paying for, maybe 5, 6, 7 years on that loan, depending on how long you go with that car loan. Whereas on your house, if you refinance for 30 years, you're going to be paying interest on that $100,000 for 30 years. So even if the interest rate is lower on your house than what today's car loan rates are, you're still going to be paying, I guarantee, like someone do the math, you'd still be paying way more in interest by taking out that home equity loan on that amount of money. And so like, again, not advice, but like if I were in the situation where I had a bunch of equity in my house personally, which I actually happen to have equity in my house because I bought it at the right time and I put money down. So with that situation, I just keep the equity in my house, and if I want to buy a car, well, I either save up enough money to pay for that car in cash, which is what I've personally done, or if I wanted to buy a car that I couldn't pay for in cash, hypothetically, I would just take out a traditional car loan. Like, just keep it simple. Seriously. I wouldn't be... I guess the other thing that I want to quickly talk about before I cap off this video, because this is something that I don't know if this is happening at a higher rate now than what it was when I worked at the dealership, but something else that I would see people do is they would borrow against their 401ks to pay cash for cars. That's another thing that I'm just like, oh, I need to make a dedicated video about this. Like, this is frustrating me. But I'm also kind of like, people should know better, but apparently not. But anyways, that's going to sum things up for today's video. Let me know what you think about this information with the fact that this is where all the cash buyers are coming from. Like, and I'll continue to research in and see if I can find anything else, but it looks like this is the answer. People are taking out loans against their, or they did about a year ago or 2 years ago when they had a bunch of equity and while interest rates were still low, and now they're using that money to buy cars. Like, just let me know what you think about it. I'll see you.